So imagine this. You and a friend walk into a car dealership on like a random Saturday afternoon.
Okay, setting the scene. I like it.
Right. And you both have your eyes on the exact same vehicle. It's a solid, reliable $30,000 sedan.
Very practical.
Very. So you both sit down at separate desks, you sign the towering stacks of paperwork, get the keys, and you drive off the lot.
Basically the exact same experience.
Exactly the same. The cars are identical. But over the next 5 years, as you both make your monthly payments, you are going to pay $8,000 more for your car than your friend will for theirs.
Oh, man. $8,000.
$8,000. Money that just, poof, evaporates into thin air.
Yeah, that's brutal.
And the crazy part, the only reason why is because of a highly secretive, invisible 3-digit number attached to your Social Security number.
Yeah, it really is the ultimate behind-the-scenes metric in American life. I mean, it operates almost entirely in the shadows.
Completely in the shadows.
But it serves as like the algorithmic gatekeeper for your entire transition into adulthood. It dictates the financial reality of literally everything you do.
It really does. So welcome to this deep dive into the credit score system. Whether you're, a teenager just getting your first paycheck or a young adult trying to sign a lease on your first apartment, this 3-digit number is essentially a secondary currency.
A secondary currency. That's a really good way to put it.
Thanks. Yeah, when we were digging through the latest 2026 Federal Reserve data alongside all these deep dive industry research reports from the bureaus themselves, and honestly, some incredibly dense legal manuals.
Oh, yeah. Those Fair Credit Reporting Act manuals are no joke.
They are so dry. But a very clear picture emerged from all of it. The system isn't just measuring wealth, it's measuring trust.
Right.
And a lack of trust is incredibly expensive.
That's the most expensive thing you can have, honestly.
Exactly. So our mission today is to completely crack open this black box, dismantle the destructive myths that are costing young people thousands of dollars, and hand you a very practical playbook for mastering the game.
Because it is a game, and it has real immediate stakes. I mean, we need to look at the macroeconomic reality that young adults are facing right now.
Just get into the numbers.
Yeah, according to the 2026 Federal Reserve data we reviewed, total U.S. consumer debt has breached an astonishing $18.57 trillion.
Trillion! With a T, that is just hard to even comprehend.
It's staggering. And at the same time, the national average FICO score, which had hovered comfortably around like 715 for years, has officially slipped to 713.
And the breakdown by age is where the alarm bells really start ringing.
Oh, absolutely.
When I was looking at the demographic cross-sections, Generation Z's debt balance didn't just creep up, it exploded by a staggering 37.7% in a single year.
That is just a massive spike.
Right. And the research attributes it to this perfect storm. You've got ballooning student loan balances, highly expensive auto financing, and just this heavy reliance on revolving credit.
Credit cards.
Yeah, credit cards, simply to bridge that widening gap between entry-level wages and a totally unrelenting cost of living.
Which creates a compounding crisis. And that brings us to this concept of the poverty tax.
I really want to dig into this because this concept blew my mind.
Yeah, so when a young adult relies on credit just to survive, their credit utilization spikes. And when that spikes, their score drops.
Right.
And when your credit score drops, the basic cost of living becomes substantially more expensive. Let's break down the exact math on that $30,000 car loan scenario you opened with.
Yes, let's do it, because it perfectly illustrates the mechanics of this tax. An $8,000 difference sounds like an exaggeration until you look at how amortization actually works.
Right, the math doesn't lie.
No, it doesn't. So I ran the numbers through a standard auto loan calculator using the current tier rates. If you walk into that dealership with what the industry calls a Subprime score,
which is anything between 781 and a 4T50.
Exactly. So if you have that, the bank looks at you, decides you are incredibly low risk, and offers you an interest rate of around 5.25% on a new car.
Okay, pretty standard. But what if you have a bad score?
Well, if you fall into the deep subprime category...
That's a score between 300 and 500.
Yeah, exactly. The algorithm flags you as a major default risk. So to compensate for the statistical likelihood that you might just stop paying, the bank dramatically increases the cost of borrowing.
By how much?
Your interest rate skyrockets to 15.84%.
Wow, 15.84. That is brutal.
And here is how that actually plays out mechanically over a standard 60-month loan. At 15.84%, your monthly payments are heavily front-loaded with interest.
So you aren't even paying off the car at first?
Barely. In the first year alone, your payments are mostly just servicing the cost of the loan. You're barely chipping the paint off the actual principal of the car.
That's so frustrating.
It is. So over the 5 years, the deep subprime borrower pays roughly $13,782 in interest. The superprime borrower pays only $5,824 in interest.
And there is that spread.
Almost exactly $8,000. That is money that could have funded a year of rent or knocked out a massive chunk of a student loan. Completely vaporized just to service the risk premium attached to a bad 3-digit number.
And, the wildest part is that this risk premium bleeds into areas of life that have absolutely nothing to do with borrowing money.
Right. It affects the fundamental infrastructure of daily life, like cell phone contracts.
Yeah, exactly. The actuarial data shows this really strong correlation between low credit scores and unpaid telecom bills.
So they just won't give you a phone.
Pretty much.
Yeah.
If your score sits below 580, getting a standard postpaid cell phone plan where you pay at the end of the month for the data you used, it becomes incredibly difficult.
Oh.
Providers will either force you into a really restrictive prepaid plan or demand a massive upfront security deposit just to hand you a phone.
And I noticed the exact same mechanism happening with insurance companies.
Oh, the auto insurance stuff is wild.
It really is. The research shows that auto and home insurers in most states utilize what they call a credit-based insurance score. And I found this fascinating because, you'd think your driving record is all that matters.
Right, like, are you a safe driver?
Exactly. But statistically, their risk models indicate that people with lower credit scores actually file more claims.
Now, the underlying causality there is hotly debated in the industry. But the actuarial reality is that insurers trust the correlation.
What do you mean by causality? Like, why do they think that happens?
Well, they believe financial stress correlates with delayed vehicle maintenance, like you can't afford new brake pads, which then leads to more accidents.
Well, that makes sense.
Or perhaps there is a higher likelihood of filing a claim for really minor damage rather than just paying out of pocket because you don't have the cash.
Wow. So as a result, even with a completely spotless driving record, a bad credit score can cause your car insurance premiums to literally double compared to a driver with the exact same record but an excellent score.
Which is just another invisible tax. And it even impacts basic shelter.
Getting an apartment.
Yeah, when a young adult signs their first apartment lease, the utility companies run soft credit checks. If your file is thin or marred by missed payments, the electric company views you as a flight risk.
So they penalize you before you even turn the lights on.
Exactly. They might demand a $200 to $500 security deposit just to connect your electricity.
That is money a young person desperately needs for rent or groceries. And looking at those legal manuals, it goes beyond housing. Employers, particularly in finance, government, or roles requiring security clearances, they pull a modified version of your credit report too.
Yeah, now to be clear, they aren't looking at the 3-digit number itself, but they are combing through your payment history.
Right. To gauge your reliability and essentially your vulnerability to bribery or financial coercion.
Which perfectly frames what this number actually represents. It is a highly sensitive predictive model.
So a credit score isn't actually like a financial GPA that grades how wealthy you are. It's more like a highly sensitive trust algorithm predicting your future behavior.
That is exactly what it is. The system isn't measuring your net worth, your salary, or your intrinsic value as a human being. It is a mathematical algorithm specifically designed to answer one highly specific question for banks.
And what is that question?
Out of 100 people with your exact financial profile, what is the exact statistical probability that you will go 90 days past due on a debt obligation within the next 24 months?
That is so clinical, just predicting if you'll ghost them in the next 2 years.
Yep, that's the entire point of the system.
Well, if this algorithm wields that much power over our financial freedom, we need to completely pull back the curtain on who built it and how it works.
We definitely do.
Because I think a lot of people, myself included before we started researching this, assume there is just one giant government computer tracking everyone's money in Washington.
Right, like some matrix-style database.
Exactly. But the ecosystem is actually divided into two very distinct halves. You have the data hoarders and you have the data graders.
That is a crucial distinction. Let's break that down. First, you have the data repositories, known as the credit bureaus.
Equifax, Experian, and TransUnion.
Right. The big three, they operate as massive private data brokers. Think of them as giant passive filing cabinets.
It's storing paper.
Exactly. Every single month, your bank, your auto lender, your credit card issuer, they all send a data file to these bureaus reporting your balance and whether you paid on time.
And the bureaus just file it away.
The bureaus simply store that information. They don't judge it.
Okay, so where does the judgment come from?
Judgment comes from the second half of the ecosystem, the companies that actually write the algorithms. And the undisputed heavyweight champion here is FICO.
FICO. I feel like everyone has heard that acronym, but no one knows what it stands for.
It stands for the Fair Isaac Corporation.
Fair Isaac.
Yeah. Back in the 1950s, before FICO existed, getting a loan was a highly subjective, localized, and often deeply prejudiced process.
Basically, the banker just looked at you and judged your vibe.
Literally, you walked into a bank, a loan officer looked at you, judged your character, considered your neighborhood, and just decided if you were trustworthy.
Wow. The potential for bias there is astronomical.
Huge. So Bill Fair and Earl Isaac, an engineer and a mathematician, they realized how flawed and biased this was.
So they tried to take the human element out of it.
Exactly. They created a standardized statistical scoring system based entirely on numerical data. And today, roughly 90% of top lenders use FICO scores to make credit decisions.
But FICO isn't a monopoly anymore, right? We have a major challenger in the ring called VantageScore.
Yes, VantageScore. And what's interesting is it was actually created by the three credit bureaus themselves back in 2006 to compete with FICO.
Oh, so the filing cabinets decided to start doing math.
Basically, yeah.
Well, when I was looking at the technical differences between the two, especially for like a young person just entering the economy, VantageScore seems vastly superior in its inclusiveness.
How so?
Well, FICO's algorithm is stubborn. It flat out refuses to generate a score unless you have an account that has been open and active for at least 6 straight months.
Right, 6-month rule.
So it's like Netflix versus Hulu for financial data. But it feels incredibly unfair that FICO needs 6 months to score you. If you're 18, you're essentially penalized just for being young.
You absolutely are.
Yeah.
VantageScore, recognizing that 6 months is a massive hurdle for an 18-year-old trying to establish their life, designed their model to generate a score with just 1 single month of credit history.
That's a huge difference, 1 month versus 6 months?
It's massive. And the mechanical differences go even deeper. The latest iteration, VantageScore 4.0, utilizes what data scientists call trended data.
Okay, let's explain how trended data actually works, because it sounds like a massive upgrade from the old system.
It really is. So traditional scoring models take a static snapshot.
Like a photograph.
Exactly. They look at your credit card balance on the specific day the bank reports it to the bureau.
Right.
If your limit is $1,000 and you happen to have a $900 balance on that specific day,
even if you're going to pay it off the next day.
right, the static algorithm assumes you are maxed out and drowning in debt, and it tanks your score.
That's so annoying.
It is. But trended data watches a movie instead of looking at a photograph. It analyzes the trajectory of your debt over a 24-month period.
So it sees the pattern.
Yes. The machine learning model looks at your monthly balances and asks a more nuanced question. Is this person a transactor who charges a lot but pays the balance off in full every month?
Which is good.
Yes, very good. Or are they a revolver who is slowly accumulating debt and paying only the minimums?
Ah, I see.
By looking at the historical trend line, VantageScore can reward people who are actively paying down debt, even if their current balance still looks a bit high.
That feels infinitely more logical. But because FICO remains the gold standard used by the vast majority of mortgage and auto lenders, we kind of have to master their specific recipe.
We do. FICO still runs the world.
And FICO guards their exact proprietary formula, like the Coca-Cola recipe, right?
Yeah, it's totally locked down. But they do publish the 5 categorical weights.
Okay, let's break down the mechanics of each one, starting with the heavy hitter, payment history.
Which dictates a massive 35% of your total score.
35%, that's the biggest chunk.
It's the foundation. It simply tracks whether you honor your agreements on time.
And the mechanics of a late payment are brutal.
Oh, they are unforgiving.
Because if you miss a due date by like a few days, you'll get hit with a late fee by the bank, but your credit score remains untouched.
Right, because the bureaus only track delinquencies in 30-day increments.
But the moment you cross that 30-day threshold,
The bank reports it, and the algorithm drops the hammer. A single 30-day late payment can stay on your permanent record for 7 years and instantly tank a great score by up to 100 points.
100 points for being 30 days late. That is wild.
The algorithm views a broken promise as the highest predictor of future default.
Okay, noted. don't be 30 days late. The next biggest slice of the pie is amounts owed, also known as credit utilization, coming in at 30%.
Yes, utilization.
I think the best way to understand the mechanics of utilization is to think of your total credit limit like the structural weight limit on a bridge.
Oh, I like this analogy.
Yeah, so if the bank issues you a card with a $10,000 limit, that means the engineers believe the bridge can safely hold 10,000 pounds before collapsing.
Right.
But if you constantly drive 9,000 pounds across that bridge every single month, the engineers start sweating.
Because you are stressing the structural integrity.
Exactly. You are stressing the structural integrity of your finances. Keeping your utilization low, say only using $1,000 of that limit, proves to the algorithm that you rely on a fraction of your capacity.
That analogy perfectly captures the systemic risk lenders are trying to avoid. If you're always near the limit, you're one flat tire away from financial collapse.
Exactly. Okay, what's the third factor?
The third factor, making up 15%, is the length of credit history. The algorithm calculates the age of your oldest account, the age of your newest account, and the average age of all your accounts combined.
So the longer the track record, the more reliable the predictive model becomes.
Right.
But I have to pause on that 15% because mathematically it creates a massive structural disadvantage for young adults.
It really does.
Like FICO already forces you to wait 6 months to get a score at all, and then it immediately penalizes you because your average age of accounts is essentially 0. It feels like an inherent bias against the youth.
It is absolutely a structural barrier, and it feeds directly into one of the most critical socioeconomic issues we uncovered in the research.
The credit invisible crisis.
Exactly. The Consumer Financial Protection Bureau reports that approximately 26 million Americans are entirely credit invisible.
Meaning they have absolutely no scorable history with the bureaus. None.
None. And another 19 million have unscorable files because their accounts are too new or inactive.
So that means 45 million adults are locked out of the traditional financial system.
Yes. And the demographic breakdown of who gets locked out is deeply troubling.
Yeah, the data shows that 15% of Black and Hispanic consumers are credit invisible, compared to just 9% of white consumers.
Right. And when the algorithmic gatekeeper cannot see you, you can't walk through the front door of a traditional bank.
You are forced to go through the back alley.
And the back alley is populated by alternative financial services, like payday lenders.
Ugh, payday lenders.
Let's look at the mechanics of a payday loan. To understand why being credit invisible is so devastating, a traditional bank won't lend you $500 for a car repair because you have no score.
Right.
So you go to a payday lender. They don't check your credit. They just need proof of income. They loan you the $500, and they charge a flat $75 fee, demanding repayment in 2 weeks when you get paid.
Now, $75 doesn't sound utterly catastrophic on the surface. Like, it's a fee, whatever, but you have to look at the annual percentage rate, the APR.
Exactly. When you mathematically annualize a $75 fee for a 2-week $500 loan, the APR is roughly 400%.
400%.
And the real trap is the structure. In 2 weeks, the borrower doesn't have the $575 to pay it off because they were already broke to begin with.
Obviously.
So the lender offers to roll it over for another $75 fee. The principal never shrinks.
Yeah.
Within a few months, the borrower has paid $600 in fees and still owes the original $500. It is an inescapable mathematical vortex designed to extract wealth from the invisible class.
That is just sickening.
It is.
Which brings us to a critical turning point in this deep dive. Because the FICO algorithm is a closely guarded secret, and because the consequences of getting it wrong are so devastating, human nature has just rushed to fill the knowledge gap with rumors.
So many rumors, folk wisdom, terrible advice passed down from generation to generation.
So if we want to hand our listeners the playbook, we first have to bulldoze the myths that are actively setting their money on fire.
Yes, let's do some myth busting.
Let's start with the most pervasive and financially destructive lie of all. Myth number 1, the idea that you must carry a balance on your credit card to build credit.
I hate this myth so much. It is the single most expensive piece of fiction in personal finance.
The myth usually goes like this, right? You use your card to buy groceries, but when the bill comes, you intentionally leave $20 or $30 unpaid, letting it roll over to the next month.
Right, because you believe you need to show the bank you are using their money to generate a credit score.
It's like leaving trash in your car to prove to passengers that you know how to clean it. It just stinks and costs you money.
That is a perfect analogy.
Mm-hmm.
FICO's own documentation explicitly states this is entirely false.
Let's explain the actual mechanics of credit card interest because it reveals why this myth is a total disaster. When you pay your credit card statement balance in full every single month, you utilize what's called the grace period.
Right. The bank essentially gives you a 30-day zero-interest loan.
But the moment you leave even $1 unpaid and let it roll over into the next billing cycle,
you lose that grace period entirely. And the loss of the grace period triggers daily compound interest.
Daily.
Yes. The bank takes your annual percentage rate. And remember, the average APR for new credit cards in 2026 is sitting at a brutal 23.79%.
Basically 24%.
Yeah. They divide that by 365, and they apply that daily interest charge to your average daily balance. By carrying a balance, you aren't boosting your score. You are voluntarily agreeing to pay 24% interest on a sandwich you ate 3 weeks ago.
That is so painful to hear.
FICO heavily rewards you for paying the balance in full. Pay it off every single time.
Absolutely. Do not pay interest to build credit. Okay, myth number 2. Checking your own credit score hurts your score.
Another classic.
I hear this from young adults constantly. They are terrified to open the credit monitoring app on their phone because they think the algorithm penalizes curiosity.
This myth stems from a misunderstanding of the 2 distinct ways your credit report can be accessed: hard inquiries and soft inquiries.
Okay, let's break those down. What is a hard inquiry?
A hard inquiry occurs when you actively apply for new credit, a mortgage, an auto loan, or a new credit card.
You're asking for money.
Exactly. The lender asks the bureau for your file to make a lending decision. The algorithm notes this hard pull and deducts a few points because statistically, a consumer seeking multiple new lines of credit in a short window is demonstrating financial distress.
But a soft inquiry operates on completely different mechanics.
Precisely. A soft inquiry happens when you check your own score, or when a credit card company pre-approves you for a mail offer, or when an employer does a background check. You are not actively seeking new debt.
So the bureaus just ignore it.
The bureaus record soft inquiries so you can see who has been looking at your file, but the FICO algorithm is completely blind to them. They have absolutely zero mathematical impact on your score.
So you could check your score 12 times a day and it wouldn't change a single point.
Exactly. Check it all you want.
That is incredibly freeing to know. All right, moving to myth number 3. Closing old credit cards improves your score.
Ooh, this one traps so many people.
Because the logic seems sound on the surface, you know? Let's say I'm 25 and I have a beginner credit card from when I was 18 that I never use anymore. Getting rid of it cleans up my financial footprint, reduces my temptation to spend, and shows lenders I don't need their money, right?
It sounds highly responsible, but structurally, it triggers a cascade of negative effects within the FICO formula.
Really?
Yes. Let's go back to your bridge analogy for the 30% utilization factor.
Yeah.
Your total available credit is the combined weight limit of all your bridges. If you have 3 credit cards, each with a $5,000 limit, your total available credit pool is $15,000.
Got it.
If you routinely charge $1,500 a month across your cards, your utilization is a very healthy 10%.
But the moment I call the bank and close that old card,
you instantly detonate $5,000 of your available credit pool. Your total capacity drops to $10,000. If your spending stays exactly the same at $1,500 a month, your utilization ratio instantly spikes from 10% to 15%.
Wait, wow.
You haven't spent a single penny more, but the algorithm sees you using a larger percentage of your capacity, and your score drops.
And it gets worse because of the 15% length of credit history factor, right? If that was your oldest card, you've just severed the deepest root of your financial tree.
Exactly. Eventually, that closed account falls off your report, and your average age of accounts plummets.
So what's the solution? Just keep a useless card forever?
Basically, yes. The mechanical solution here is simple. If the old card charges a high annual fee that you are getting no value from, you can call the issuer and ask for a product change, downgrading the account to a no-fee version while keeping the credit line and the history intact.
Oh, I didn't know you could do that.
Yep. And if it already has no fee, put it in a drawer. Tie it to a small, recurring subscription, like Spotify or a $3 cup of coffee once a month, and set it to auto-pay in full.
Just let it sit in the background, anchoring your credit age and inflating your total available credit limit for the rest of your life.
Exactly. It's free points.
Brilliant. Okay, myth number 4. Debit cards build credit. People assume that because the card has a Visa or MasterCard logo on it, the bureaus are tracking it.
This comes down to the fundamental definition of credit. A debit card is essentially an electronic check. It is tethered directly to the cash sitting in your checking account.
Right, it's my money.
When you swipe a debit card, you are spending your own money. Because no bank is extending you a loan, there's absolutely zero risk of default.
And because there is no risk, there is no predictive data to measure.
Exactly.
Yeah.
Debit card transactions are never, ever transmitted to the credit bureaus. They are completely invisible to the FICO algorithm.
Which leads perfectly into the final myth we need to crush. Myth number 5, the assumption that high income equals a high credit score.
I hear this all the time.
People assume that doctors and lawyers automatically have 800 scores simply because they make a lot of money.
What's truly fascinating about the data architecture of a credit report is what is intentionally left out: your income, your bank account balances, your stock portfolio. None of that is reported to Equifax, Experian, or TransUnion.
They have no idea how rich you are.
None. The algorithm is entirely blind to your wealth. It only measures your mechanical management of debt.
I love this point because it makes the system a meritocracy of habits.
Very much so.
You could be a barista making $30,000 a year. But if you have 2 credit cards, keep your utilization at 5%, and never miss a payment for 5 years, you will easily command an elite 800 FICO score.
Yes, you will.
Conversely, you could be a surgeon pulling down $400,000 a year. But if you buy a boat, max out 5 luxury credit cards, and miss a mortgage payment because you forgot to set up autopay,
Your score will plummet into the low 600s. Wealth gives you cash flow, but behavioral management builds the score.
it measures reliability, not riches.
Perfect way to summarize it.
Okay, the slate is clean, the mix are busted. Let's pivot from theory to execution.
The fun part.
Yes. Imagine an 18-year-old listener tuning in right now, or maybe a parent who wants to set their kid up for absolute success. They're staring at a completely blank file. How do we engineer a 700-plus credit score from scratch? Let's open up the playbook.
Let's do it.
Strategy 1 is what the industry calls the authorized user hack. Explain the mechanics of how this allows a teenager to literally clone data.
This is the most powerful loophole in the entire system, provided it is used safely.
Okay.
The major credit card issuers allow the primary account holder, usually a parent or guardian, to add a secondary person to their account as an authorized user.
Right, so the child gets a physical card with their name on it, but the parent remains legally responsible for the debt.
Yes, but the magic happens in the data transfer, because the bank doesn't just send the child's new spending to the bureaus.
What do they do?
When a child is added as an authorized user, the bank takes the entire historical data file of that specific credit card and copies it directly onto the teenager's brand new credit report.
Wait, really? The whole history?
The whole history. If the parent has had that specific card open for 15 years with a flawless payment history and a huge credit limit, the 18-year-old instantly inherits a 15-year perfect payment history.
That is insane. They just bypass the FICO 6-month waiting period entirely?
They bypass it and instantly generate a robust, mature score. Is it a massive head start?
But we have to emphasize the extreme danger of this hack.
Oh, yes. Please do.
Because data cloning works both ways. If the parent has terrible credit, or if they suddenly face a financial hardship and max out that specific credit card, that high utilization and any missed payments are also copied onto the teenager's report.
Right, which would tank the child's score before they even enter the workforce.
So you should only execute this strategy with a parent or mentor whose financial habits are absolutely bulletproof.
It requires complete transparency and trust. You really have to know they are paying that bill in full every month.
But what if the authorized user route simply isn't an option? Like, your parents don't have good credit. This brings us to strategy 2, the secured credit card.
The training wheels.
Yes, because if you have no credit, traditional banks view you as an unknown risk. A secured card solves the risk equation by collateralizing trust.
I was reading through the Chase and Navy federal guides on these, and the mechanics are brilliant.
Walk us through it.
You go to the bank, and you hand them a cash deposit up front. Let's say $200.
Okay.
The bank locks that $200 in a secure account and then issues you a credit card with a strict $200 limit.
Now, to the consumer, it feels like you are just borrowing your own money, which seems counterintuitive. Why not just use a debit card?
Well, from the bank's perspective, they have completely eliminated their exposure. If you go on a spending spree, max out the $200, and vanish into the night, the bank simply seizes your $200 deposit to cover the debt. They lose nothing.
But the crucial mechanism here is that the bank treats this exactly like a normal unsecured credit card when reporting to Equifax, Experian, and TransUnion.
Exactly. The bureaus don't flag it as secured. They just see a revolving credit line with perfect on-time payments.
So you basically just Buy a tank of gas once a month, pay the bill in full on the exact due date, and let the algorithm do its work.
Yep. And after 6 to 12 months of demonstrating mechanical reliability, the bank's internal algorithms will upgrade your profile.
So you get your money back.
They will refund your original $200 deposit and automatically graduate the account into a standard unsecured credit card with a much higher limit.
That is the perfect training wheel for building a robust file from absolute zero.
It really is.
Which leads us to strategy 3, and this is where the fintech landscape in 2026 is actually evolving to really help young adults: rent and utility reporting.
Finally, this is such a big deal.
Historically, rent has been the ultimate frustration. You could pay $1,500 a month for a cramped apartment on time for 5 straight years, and your credit score wouldn't budge a single point because landlords generally don't report to the credit bureaus.
Right. Which is just fundamentally unfair. But that historical blind spot is finally being addressed.
How so?
We are seeing the rise of third-party reporting services. Platforms like Navy Federal's Bloom Plus or independent apps that utilize secure APIs to link directly to your checking account.
Okay.
These platforms use open banking protocols to scan your transaction history. They identify your monthly rent payments, your cell phone bills, your internet, and even your recurring streaming subscriptions like Netflix or Spotify.
And once they verify that you are consistently paying these daily living expenses,
they bundle that data and transmit it directly to Equifax, Experian, and TransUnion as a positive trade line.
it essentially generates a scoreable file out of thin air using the money you are already spending just to survive.
It is a massive victory for the credit invisible.
It truly is.
Yeah.
But while we are talking about massive amounts of money, we have to tackle strategy 4, handling student loans.
Oh boy. Student loans.
Yeah. Student debt is the ultimate double-edged sword for young adults. On the positive side of the algorithmic ledger, a student loan is an installment loan.
Meaning it has a fixed monthly payment over a set term.
Right. Which actually adds vital diversity to your 10% credit mix category, proving to FICO that you can manage something more complex than just a revolving credit card.
True. But the downside risk is catastrophic.
Let's talk about the transition phase because that's where people mess up.
Yeah, when a young adult graduates, they're usually in a massive transition phase. They're moving to a new city, switching email addresses, starting a new job, just trying to figure out life.
Chaos.
Total chaos. And in that chaos, it is incredibly easy to lose track of the loan servicer's paperwork, especially after the post-graduation grace period ends.
And this is where the FICO penalty is unforgiving. If you miss a student loan payment by 30 days, the algorithm doesn't care that you were disorganized or moving across the country.
No, it does not.
It treats a defaulted student loan with the exact same severity as a defaulted credit card. Your score drops like a stone.
Furthermore, young adults often use forbearance or deferment when they can't afford the payments.
Which feels safe, right?
While deferment prevents a devastating default, the interest often continues to capitalize, meaning your balance grows larger over time, which can drag down your overall financial profile.
So what is the mechanical defense here?
The only foolproof mechanical defense is to put every single student loan on aggressive autopay the literal second it enters repayment.
Set it and forget it. Okay, so we have the building blocks: authorized users, secured cards, rent reporting, and student loan management. Let's talk about best practices for navigating daily life. When a young adult is actively building their file, they're going to need to apply for new lines of credit eventually.
Right. They want to get an auto loan or a rewards card.
So how do they do that without triggering alarms?
The industry relies on a highly effective mechanical guideline called the 222 rule for managing hard inquiries.
The 222 rule. Walk me through it.
First, you should wait a minimum of 2 days between any credit applications.
Why 2 days?
Rapid-fire applications in a single afternoon trigger automated fraud algorithms because it looks like a desperate cash grab or identity theft.
Okay, that makes sense. What's the second 2?
Second, you should submit no more than 2 applications in a rolling 2-month period to minimize the density of hard inquiries hitting your report.
Okay, and the final 2?
And third, submit no more than 2 applications with the exact same lender to avoid their internal velocity limits.
Wow. So wait 2 days, no more than 2 apps in 2 months, and no more than 2 apps with the same lender. That's a great defensive strategy.
It keeps the algorithm calm.
And for an offensive strategy, we need to revisit the utilization mechanics. We talked earlier about keeping your bridge weight under 30%. That's the baseline advice every personal finance blog gives you.
Right. The 30% rule is everywhere.
But if you dive into the data profiles of people who command elite FICO scores, like the 800-plus club, they operate on an entirely different level. They utilize the 10% rule.
Yes. The superprime consumers do not wait for the monthly statement to arrive.
What do?
They treat their high-limit credit cards exactly like debit cards. They use the card for the fraud protection and the rewards points, but they log into their banking app and actively pay off the balance every single week.
Oh, wow. Every week?
Yeah. By doing this, whenever the bank's computers take that random monthly snapshot to send to the bureaus, the reported balance is always hovering near zero. Their utilization sits at 1 or 2%.
And the FICO algorithm rewards this hypervigilance with maximum points.
Exactly. It's gamifying the system.
But, it raises a really interesting philosophical question that I hear from young people all the time.
What's that?
Well, if the system is this complex and the penalties for mistakes are this harsh, is it better to just sit out entirely? Is it better to have bad credit or no credit at all?
Oh, that's a great question. From a purely mechanical standpoint, having no credit is vastly superior.
Really? Why?
Because a blank file is a clean slate. As we just discussed, with a secured card and some rent reporting, you can engineer a 700-plus score from scratch in roughly 8 to 12 months.
That's relatively fast.
It is. Bad credit, on the other hand, means the file is contaminated with deeply negative data. Late payments, collections, charge-offs. That data is sticky.
Sticky data.
It legally remains on your report for 7 long years. Digging out of a bad credit hole requires years of flawless behavior to mathematically dilute the negative impact of those past mistakes. No credit is an opportunity. Bad credit is an anchor.
Okay, let's pivot to the darker reality of this system, because let's say you are the perfect consumer.
Okay, playing devil's advocate.
Yeah, you are following the 222 rule. Your utilization is at 2%. You have auto pay locked in. And then one Tuesday morning, you log into your banking app and your credit score has inexplicably plummeted 80 points.
That happens.
You didn't do anything wrong. What happened?
You've just collided with the sheer bureaucratic incompetence of massive data aggregation.
The filing cabinet's messed up.
Big time. The system is run by computers, but it is fed by humans, and errors are the silent, ubiquitous killers of credit scores. The Federal Trade Commission's exhaustive research indicates that roughly 1 in 4 consumers has a material error on their credit report that is actively dragging down their score.
Wait, 1 in 4? That means 25% of the American public is walking around paying a poverty tax because of someone else's mistake?
It's outrageous.
When I was reading through the FCRA legal manuals, the types of errors blew my mind. I assumed it was mostly just identity theft.
Which is terrifying on its own.
Yeah, as someone stealing your social security number and opening an auto loan in your name. But the mundane errors are actually far more common.
They are incredibly common, and they are purely mechanical failures. A bank might report a duplicate account where a single auto loan is accidentally listed twice on your report, making the algorithm think your debt burden is twice as heavy as it actually is.
Oh, that's awful.
Or you become the victim of a mixed file.
What is a mixed file?
If your name is John Smith, and there's another John Smith in your zip code who just defaulted on his mortgage, the Bureau's algorithms might lazily merge your data files based on the similar name and address, saddling you with his foreclosure.
So if I pull my report and see another John Smith's foreclosure ruining my life, how do I actually fight back? I want to get very granular here.
Let's do it.
Because the natural instinct is to just pick up the phone and yell at customer service. But the legal manuals make it very clear that phone calls are useless. What is the actual legally binding dispute process?
You have to exercise your rights under the Fair Credit Reporting Act, or FCRA. Step 1 is getting the raw, unvarnished data.
So not a third-party app.
Do not use a colorful third-party app for this. By federal law, you must go to annualcreditreport.com to pull the official, highly detailed files directly from Equifax, Experian, and TransUnion.
Okay, I have the reports. I found the error. What is step 2?
Step 2 is assembling your arsenal of physical proof. The bureaus operate on documentation, not emotion. If the report claims you missed a payment in March, you must dig into your bank's archives and print out the official statement proving the money left your checking account on time.
And if it's identity theft?
If you are dealing with identity theft, you must file an official police report and get a copy of it. You need unassailable evidence.
And step 3 is launching the dispute. But the manual was very specific about who to target. I can't just dispute the credit bureau. I have to fight a war on 2 fronts.
Yes.
I have to dispute the bureau and something called the furnisher. Explain exactly what a furnisher is, because that term is pure legal jargon.
A furnisher is the actual entity, the bank, the collection agency, the auto lender, that originally transmitted the bad data to the credit bureau.
Oh, okay. The bureau is just the filing cabinet. The furnisher is the one who put the bad file in the cabinet.
Perfect way to put it. To legally false a correction, you must draft a physical letter clearly identifying the error, attach copies of your evidence, and mail it to both the credit bureau and the furnisher.
Wait, snail mail? And I can't just drop it in a mailbox, right? The guide stressed the absolute necessity of certified mail.
Yes. You must send these letters via USPS certified mail with a return receipt.
Why is that so important?
This is where you leverage a very specific piece of federal law known as Regulation V. Under Regulation V, the moment the furnisher signs that green certified mail receipt, a strict 30-day legal countdown clock begins.
Huh.
The furnisher legally has exactly 30 days to conduct a reasonable investigation into your dispute. The certified mail receipt is your indisputable proof in a court of law of exactly when that clock started ticking.
I love the mechanics of this. So what happens if I mail my perfectly documented dispute? The bank signs the receipt and then they just ghost me.
They often try.
Right, so day 31 arrives and I've heard nothing. Or what if they just rubber stamp a generic denial without actually looking at my evidence? Do I automatically win?
You don't automatically win, but their silence or negligence gives you the ultimate leverage. When the 30-day clock expires without a proper resolution, you escalate the nuclear option.
Which is?
You file a formal complaint with the Consumer Financial Protection Bureau, the CFPB.
And why does the CFPB terrify banks so much?
Because the CFPB is the federal watchdog with the power to issue massive fines. When you file a CFPB complaint and upload your certified mail receipts proving the bank ignored you, the CFPB contacts the bank's executive compliance office directly.
Oh, wow. So you bypass customer service entirely.
Entirely. The CFPB mandates a highly scrutinized formal response within 15 days. Banks absolutely loathe having unresolved CFPB complaints on their public record, so this almost always forces a sudden miraculous deletion of the erroneous data.
It is incredibly empowering to know the mechanical levers of the law are actually designed to protect the consumer if you know how to pull them.
They really are.
But, because that certified mail process feels daunting and bureaucratic, a massive, highly predatory shadow industry has emerged to exploit young adults.
Yes, it's disgusting.
We need to warn our listeners about the scams flooding TikTok and Instagram right now. I constantly see these slick videos from so-called credit repair experts promising to hack the algorithm and delete all your debt overnight.
The predation in this space is rampant. The Credit Repair Organizations Act makes it explicitly illegal for any company to charge you upfront fees before they have actually successfully removed an error from your report.
Wow. So they can't charge you first.
Right. Yet these illegal operations routinely demand $500 or $1,000 up front, and they don't have a secret hack. Usually they just flood the bureaus with frivolous dispute letters claiming every single item on your report is false, hoping to temporarily jam up the 30-day investigation window.
Does that even work?
It is completely ineffective, and it just leaves you poorer.
But there is a specific scam that goes far beyond just wasting your money. It crosses the line into severe federal felonies. I want to dive into the mechanics of the CPN scam because young adults with ruined credit are the primary targets, and they usually have no idea what they are actually buying. What exactly is a CPN?
CPN ostensibly stands for Credit Privacy Number. A scammer will slide into the DMs of a young person who is complaining about a terrible credit score. They will offer a highly seductive pitch.
What's the pitch?
They'll say, for $500, I will generate a brand new, completely clean 9-digit number for you. You use this CPN instead of your social security number on credit card and apartment applications, and you will get a totally fresh start.
The mechanics of that sound entirely illegal. The government issues social security numbers, not random guys on Instagram. Where are they getting these 9-digit numbers?
This is the truly sinister part. They aren't generating random numbers. Through data breaches on the dark web, these scammers are actively stealing the real social security numbers of infants and young children.
Oh my God.
Because children do not have credit files yet, their numbers appear clean to the algorithm. The scammer sells a child's stolen SSN to you under the guise of a CPN.
That is horrifying. So they're stealing kids' identities, and if a young adult actually uses that number to apply for an auto loan?
They are committing multiple federal crimes. By attaching your name to someone else's social security number to obtain a loan, you are actively engaging in synthetic identity theft and wire fraud.
Which means prison.
If caught, you aren't just dealing with a bad credit score, you are facing federal prison time. The absolute rule of the game is this: never, ever use anything other than your legally issued social security number. There are no secret backdoor numbers.
Okay, let's step out of the criminal underworld and look toward the horizon, because we are recording this in 2026, and the foundational rules of credit scoring are actively shifting right beneath our feet as Gen Z fully enters adulthood.
The landscape is changing so fast.
I want to talk about the future of credit, starting with the massive explosion of buy now, pay later, or BNPL, platforms like Affirm, Klarna, and Afterpay.
BNPL has completely rewired the psychology of online retail.
It really has. When you go to checkout with a pair of sneakers or a new laptop, the option to split the cost into 4 painless bi-weekly payments is incredibly seductive. And for a long time, young adults correctly viewed BNPL as a financial cheat code.
Right, because historically, BNPL loans bypass the credit bureaus entirely. You could rack up thousands of dollars in microloans across 5 different apps, and because they weren't traditional revolving credit cards, FICO was completely blind to them. You can hide your debt from the algorithm.
But Klarna didn't used to report, now they do.
Yes, the architecture of the system has caught up. The major BNPL providers recognize that their data is highly predictive of consumer behavior. So they began reporting both on-time payments and missed payments to Equifax, Experian, and TransUnion.
So FICO can see it now.
The newest iterations of the scoring algorithms, specifically FICO 10 and FICO 10T, are now actively ingesting and weighting this BNPL data. The phantom debt is now highly visible.
So mechanically, what does that mean for a 19-year-old listener? If they use an app to split a $50 pair of shoes into 4 payments, and they accidentally overdraft their checking account and miss the 3rd payment,
that tiny mistake is now fully integrated into their permanent file. It carries the exact same mechanical weight and mathematical consequences as defaulting on a traditional credit card.
Wow.
A missed payment on a $50 pair of shoes today could mathematically disqualify them from securing a mortgage or an auto loan 2 years from now.
That is a massive paradigm shift. But it pales in comparison to the technological leap that really blew my mind during our research. The credit bureaus are no longer just looking at how you pay your bills. Lenders are actively deploying artificial intelligence to scan alternative data points.
Oh, the AI underwriting. This is wild stuff.
Let's dig into the mechanics of AI underwriting and the digital footprint.
This represents the bleeding edge of fintech. As we discussed earlier, traditional lenders are desperate to find a way to score the 26 million credit-invisible Americans safely.
Right.
Since they don't have traditional FICO files, lenders are unleashing machine learning algorithms to scrape alternative data sets, analyzing the digital exhaust you leave behind every time you use the internet.
And the behavioral correlations these AI models are discovering are deeply strange. According to the data sets, the algorithms have determined that consumers who apply for loans using an iPhone default at roughly half the rate of consumers applying via an Android device.
Yes, half the rate. And the correlations go beyond just hardware into software preferences.
Yeah.
The AI parses the domain of your email address.
Wait, like Gmail versus Yahoo?
Exactly. Statistical models show that applicants who use premium enterprise-level email services, like an Outlook address, have an incredibly low default rate of just 0.51%.
Okay.
However, applicants who use older, free consumer-to email services, like Yahoo or Hotmail, default at a much higher rate of 1.96%.
Wait, I need to pause here and understand the causality. The AI is observing how you browse the web as well, right? I read that if you navigate to a lender's website by first using a highly analytical price comparison tool, you are statistically half as likely to default as someone who impulsively clicks on a flashy banner ad while scrolling through social media.
That is correct. The algorithm captures the metadata of your digital journey.
But why, mechanically, why does having a Yahoo email address or clicking an Instagram ad make you a higher credit risk? The email provider doesn't control your bank account.
It comes down to behavioral and socioeconomic proxies. The AI isn't saying that Yahoo inherently makes you broke. It is finding massive overarching patterns in the data.
What kind of patterns?
Early adopters of expensive new technology, like the latest iPhones or enterprise software, often correlate with higher disposable incomes and stable corporate jobs.
Okay, I see that.
Furthermore, a consumer who spends an hour using a price comparison tool is demonstrating behavioral traits of patience, analytical thinking, and delayed gratification. Those exact same behavioral traits highly correlate with the discipline required to pay a 60-month auto loan on time.
And the person clicking the ad?
Conversely, a consumer who impulse buys a loan from a social media ad is demonstrating impulsivity, which mathematically correlates with higher default risk.
Okay, I understand the data logic, but the implications are staggering. If an algorithm is deciding my auto loan interest rate based partly on the fact that I'm loyal to Android or that I made my email account in 2010 on Yahoo, that feels incredibly invasive.
It does.
More importantly, it feels like a massive loophole for discrimination. That sounds borderline discriminatory.
You are hitting on the central controversy in algorithmic underwriting, which regulators call proxy bias.
Proxy bias.
The law strictly forbids lenders from discriminating based on race, gender, or zip code. And the AI is not explicitly programmed to look at those factors, but the AI is programmed to optimize for low default rates at all costs. Right. So if marginalized or lower income demographic groups are statistically more likely to utilize free Yahoo accounts or affordable Android phones, and the algorithm aggressively penalizes Yahoo and Android users.
And the algorithm is effectively, if unintentionally, discriminating against low-income and marginalized borrowers. It is laundering the discrimination through a technological proxy.
Exactly. It's a massive regulatory blind spot that federal agencies are currently scrambling to understand and police. The data is highly predictive, but the mechanics of how it predicts it challenge our fundamental notions of fairness.
It sounds like we are accelerating into a dystopian sci-fi novel where every click is graded.
It really does feel that way sometimes.
But to balance the scales, the research also highlights some incredibly positive technological innovations that actively empower the consumer. Let's talk about the mechanics of open banking, specifically tools like UltraFICO.
Open banking is the antidote to the rigid FICO 6-month waiting period. It operates on the principle of consumer permission data.
What does that mean?
If you are a young adult with a thin file, you can voluntarily use an API to grant the credit bureau read-only access to your daily checking and savings accounts.
Okay, mechanically, how does looking at my checking account override a bad credit score?
Because it allows the algorithm to analyze your actual real-time cash flow. Under the old FICO system, if you never use a credit card, you are a ghost, regardless of how much cash you have.
Right, wealth wasn't tracked.
But with UltraFICO and open banking, the algorithm scans your checking account and sees the raw mechanics of your life. It sees that you have received a steady direct deposit every 2 weeks for 3 years.
Okay.
It sees that you have a healthy cash cushion, and most importantly, it sees that your account balance has never dropped below zero into overdraft.
That is huge. It completely bypasses the reliance on revolving debt to prove trustworthiness.
It really does.
It allows a young person to say, look, I don't believe in credit cards, but here is the mathematical proof of my financial stability based on the cash I earn and save every single day. It puts the power of proof back in the consumer's hands.
Exactly. It democratizes the underwriting process by utilizing the data you already generate just by existing in the modern economy.
All right, we have traversed a massive landscape today.
I really covered a lot of ground.
We've broken down the $8,000 poverty tax of a bad score, dissected the inner mechanics of FICO's algorithms, destroyed the myths about carrying balances and closing cards, laid out the playbook for building credit from zero, weaponized the legal system against reporting errors, and stared into the AI-driven future of lending.
It's a lot to take in.
Let's distill all of this complexity into a final synthesis.
Okay, if we synthesize the core mission of this deep dive into one guiding principle, it is this. Your credit score is an algorithmic gatekeeper, and it absolutely dictates the underlying cost of your life.
Yes.
But it is a gatekeeper bound by rigid, highly predictable mathematical rules. And any system built on rules is a system you can master. Pay every single obligation on time. Keep your structural credit utilization under 10%. Keep your oldest accounts active to anchor your history. And aggressively utilize your legal rights under the FCRA to keep your data pristine.
Thank you to everyone listening for spending your time with us on this deep dive. The stakes are too high to remain invisible. As we close out, I want to challenge you to reflect on this information and take one immediate, highly specific action today to improve your mechanical standing.
Just one small thing.
Yeah.
No.
Maybe it's opening your banking app right now and locking in auto pay for the minimum balance on your credit card so a 30-day late mark never destroys your file. Or maybe it's finally logging into annualcreditreport.com and pulling your raw data to hunt for those duplicate accounts. Don't wait. Take one action today.
And I will leave you with a final provocative thought to mull over building on the reality of those AI algorithms we discussed.
Let's hear it.
If machine learning models are already silently calculating our financial trustworthiness based on whether we swipe on an iPhone or what email provider we selected a decade ago, what other casual clicks, daily swipes, and seemingly meaningless digital habits are we actively engaging in online today that might secretly be dictating the boundaries of our financial freedom tomorrow?
That is the thought that will absolutely change how I browse the internet tonight.
Honestly, same.
But remember, while the architecture of the system is incredibly complex and constantly evolving, you now possess the actual playbook. You understand the math. You have the tools to actively engineer your financial narrative rather than letting a black box algorithm passively write it for you.
Precisely. The system demands participation. Stay deeply informed, be rigorously proactive, and fiercely guard the integrity of your data.
Because the next time you walk into a dealership to buy that $30,000 car, you are going to be the one sliding into the driver's seat with the 5.25% interest rate, knowing exactly the mathematical maneuvers you executed to earn it. Thanks for listening, and we'll catch you on the next deep dive.